minus all the other expenses, which in this case is that 1872. So we're going to say this equals this number, the gross profit less minus the 1872, and enter. And that shows us 4386 should tie out to this number. We can easily verify that by highlighting all of the income statement accounts and know that the bottom line should add up to that number. So it has to work, and it currently does work. And note that we only have these two that we haven't found a home for now. So in the last statement, we need to find a home for those two numbers. And also, we also note that all of these numbers will add up to this. See, there, and that's what needs to be here. So that's what we will do on the statement of owner's equity. Now note that the statement of owner's equity, you're going to ask, does it look like this in terms of the date, or does it look like this? And the answer is it looks like this. Why? Because we're talking about the timing of the equity account in this case. So I'm just going to go ahead and paste. I'm going to paste that in there. And so now we're gonna say what happened to the value of the company over time. Well, it started here. Remember, that's the beginning balance. So I'm going to copy that and say that's where we're starting from. I'm going to paste that 1, 2, 3. We just have to kind of know that that's the beginning balance as of April 1st. In this case, I'm going to say 20x1, and I'm going to put that in the outer column. This has a credit in it. Therefore, we're going to flip the sign by saying instead of equals, we're going to put negative. And then I'm going to go up here and I'm going to point to that number and enter. So we want a positive number, no debits and credits over here. That's where we're going to start. Then we're going to show the activity. The activity could be broken out as everything underneath it, all this stuff. But we've already done all this stuff. We don't need to do that again. That is encapsulated in the number of net income. So we're going to start off with net income. The book value of the company starts here. It's going to go up by net income because that's the value we generated through the month. That's going to equal what we already calculated, the 4386, and enter. So we have that. And so now we found a home for all this. I'm going to make this one, I'll make it a different color since we're kind of in here. And then we've got draws. That's the only one we haven't found a home for. So draws is going to have to be the last one. So we're going to copy that. That's going to have to go here. But, you know, we have to know which ways draws is going to go. And note, how do we know that? Well, one, I mean, this is a credit. That's a debit. If I highlight the two, then it's a subtraction. It's got to go down. And two, it's going to go down because this is the book value of the company. If the owner drew money out of the company, the book value needs to go down by the money that went out, or whatever went out, the assets that were drawn from the company, probably money. Okay, so we're going to go down here and I'm going to say that needs to be less than, I'm going to say less draws. And that's going to equal the 10,000 and enter. Then we usually call this an increase in the capital, but in this case it's going to be a decrease. And how do we know that? Because the draws is actually larger than the income. So it's going to be a decrease. Let's put that in here. So here we have the decrease in equity, and it would usually be calculated as income less expenses would clearly be the idea here. But because the draws are larger, and once again, I don't want to end up with a negative number. I want to tell our reader that it is a subtraction problem through the fact that it says decrease in this case. So I'm actually going to say it's the draws less the income, just so we come up with a positive number. A couple ways we could do that, obviously, but let's take a look at that. We're going to say the 10,000 less the 4,386, enter. Again, that's only happening because the draws happens to be larger. That's hopefully not the case for most time periods, but it happens to be the case in this time period. Now, you might be asking, can we do that? Can we draw out more than we earned? And if we take a look at what we have here, notice we earned this much, we drew out this much. Why can we do that? Because we earned more money in the prior periods. So as long as we do that in one period and we have excess equity in the accounts from prior periods, that's not generally a problem. If, however, we are drawing out more money than and our equity accounts goes negative, then that could be an issue. But in this case, we're still going to have a positive equity account because we're only talking about 1 month. Now the final account here is going to be, I'm going to copy this. We're going to put that on the bottom. It's going to paste it 1, 2, 3. But we're talking about capital not as of April 1st, but now the ending capital as of April 31st. We're going to scroll over here. We're going to do something only with one column's worth of numbers. That's going to be where we started, plus the net decrease in this case. So remember, that's a net decrease indicated by the wording. Therefore, this has to be a subtraction problem. So we're going to take this equals the 184,550 minus this 5614 and enter, and that gives us the 178,936. How can we check if that number is true and correct? Well, we can say, well, it's going to be this credit plus the debit minus the credit, credit plus the, minus the debit plus the credit minus the debit, 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 and that should equal the 178,936, 178,936. That number should also match with this number here. So that number is going to tie out, and we may even want to indicate that. I've indicated that in other places by making that a yellow number like that. So now that ties out here. We may even want to show that with a formula. We don't really have to, because obviously when we print the financial statements, no one's going to see that this is drawing from here and it's not drawing from the other financial. But we could delete that and say this equals now this number and enter. And of course, now we're still in balance, and we can see what ties out here. The yellow numbers do the assets equal liabilities plus the equity. The capital account, we're going to tell more of a story about that through the income statement and the equity. At the end of those whole story, we come up with the same number that gives us more detail about that. What is the more detail it tells us? It tells us the net income, which we're now breaking out to net sales, which includes sales less the contra sales accounts of sales returns and allowances. The cost of goods sold minus the cost of goods sold, our major expense, gives us the gross profit. Then we're breaking out the operating expenses and the total administrative expenses and selling expenses, and that comes up with our net income. So this is how we did overall over this time period, and then how we did less the money that we drew out personally leaves us with the ending capital balance here.